We barely think twice about spending a couple of dollars a day, but we almost never stop to ask what the same $2 could become if we let it grow. And when you see the actual numbers behind it, it becomes hard to look at $2 the same way again. In this video, I'm going to walk you and John through how to make those couple of dollars actually work for you. We'll break down what dividends are, how they grow over time, the math behind reaching $1,000 a month, and the key numbers that keep you safe. I'll show you the 5-stock portfolio behind this strategy, and in the end, I'll show you how a simple $2 a day habit can be potentially turned into a portfolio worth over $400,000 that pays more than $1,000 a month in dividend income. Before we look at the portfolio, first you have to understand what dividend investing really is and why it works the way it does. Dividend investing sounds more complicated than it really is. Once you understand what dividends actually are, everything becomes much clearer. A dividend is just a piece of a company's profits that it shares with you for owning its stock. It's basically the company's way of saying, hey, thank you for being a part of this. Some companies reinvest all their earnings back into their growth, while others, usually more established ones, share a steady slice of their profits through regular dividend payments. Another simple piece to understand is the dividend yield, which tells you how much income a company pays each year relative to its share price. It gives you a quick sense of how much your money can actually earn while you hold the investment. Once you get this basic idea, dividend investing feels far less confusing. Now that the basics make sense, it becomes a lot easier to see why dividend investing works as well as it does. One of the biggest reasons people are drawn to dividend investing is the sense of stability it brings. When you invest in companies that share their profits consistently, you're not relying on unpredictable price swings to feel confident about your progress. Instead, you're building an income stream that grows alongside your portfolio. This makes dividends especially comforting during market volatility, because even when prices move up or down, the payments usually continue without interruption. Another major benefit is predictability. Unlike growth stocks, where your returns depend on selling shares at the right moment, dividends arrive on a schedule. You know roughly how much you'll receive and when you'll receive it. That cycle of income makes it easier to plan, easier to stay focused, and easier to feel in control of your long-term financial goals. All of this ties directly into the goal of earning $1,000 a month. You're not trying to time anything or chase quick wins. You're building an income stream that becomes more reliable, more consistent, and more meaningful the longer you stick with it. With that in mind, let's look at the numbers behind earning $1,000 a month. Before John gets there, though, quick shout out to the sponsor of this video, Moomoo. If you've been investing through your bank or one of those bare-bones apps, this might be a good upgrade for you. Moomoo is a free platform that gives you real-time market data, advanced tools, and zero-commission trades all in one clean, easy-to-use app. New users right now can get up to $1,000 in NVIDIA stock just for opening an account and making a qualified deposit. The more you deposit, the more NVIDIA stock you earn. It starts at $20 for $100 and goes all the way up to $1,000 in stock if you deposit $50,000. That's on top of their usual promos. You still get 8.1% APY on uninvested cash, and yes, that cash is FDIC insured up to $1 million. You'll also get access to Morningstar research, analyst ratings, and premium news sources like the Wall Street Journal and Bloomberg. So if you want to check it out, the link is in the description and pinned comment. Even if you're just curious, the promos alone make it worth a look. So thanks again to Moomoo for supporting the channel. Let's get back to the numbers behind earning $1,000 a month. Dividend investing becomes far more powerful once you understand the numbers behind it, because the math turns what feels like a big dream into something concrete. If your goal is to earn $1,000 every month, the first step is to look at the yearly amount that you're targeting. $1,000 a month equals $12,000 per year, and that annual number becomes the foundation for understanding what kind of portfolio you eventually need to build. From there, the key idea is dividend yield, which shows how much income you earn each year based on your investment. For example, a 3% yield means every $10,000 invested pays about $300 a year. But yield alone doesn't tell the whole story. What truly matters is how quickly a company grows its dividend and how consistently you reinvest those payouts. Once you factor in dividend growth and reinvestment, reaching $12,000 a year in income becomes far more realistic because your dividends begin increasing automatically over time. That's where the real acceleration happens. If a company grows its dividend by, say, 10% each year, your income rises without you buying additional shares. Your payouts keep increasing simply because the business is doing well. When you combine this with reinvesting the dividends you receive, your share count increases automatically and your portfolio begins compounding. What might start small, like receiving $20 or $30 in dividends, slowly builds into hundreds and eventually thousands over the years. Now, even with strong dividend growth, diversification remains essential. Relying on a single stock, even one with great numbers, exposes you to unnecessary risk. A company paying a 4% yield today might reduce it in the future, or an industry that looks safe might underperform. By spreading your investments across multiple high-quality dividend payers, you protect yourself from the ups and downs of any one business. Diversification ensures that if one stock lags, another can keep your income climbing. It smooths out the emotional side of investing, helps you avoid rushed decisions, and gives you a steadier, more confident path toward that long-term goal of earning $1,000 every month in passive income. But the math only matters if you're using a strategy that actually supports it, and that's where compounding comes into play. When people start thinking about building a dividend portfolio, the first instinct is usually to jump straight into picking stocks. It feels exciting, but the truth is that the strategy behind your choices matters more than the choices themselves. And the biggest difference comes down to whether you're approaching this with a short-term mindset or a long-term one. A short-term approach focuses on quick gains and chasing higher yields. It often needs a big upfront investment and a lot of attention to timing, which can get stressful very quickly. Your returns depend on being right in the moment. And if your goal is to build a steady, predictable income, that kind of strategy usually burns out before it pays off. A long-term strategy works completely differently. It leans on patience and consistency instead of timing the market. You let your portfolio grow through reinvested dividends and gradual share price appreciation. You don't need a huge starting amount, and you don't need to guess what the market is going to do next week. What you do need is the willingness to keep adding to your portfolio even when the progress feels slow at first. Over time, companies raise their dividends and your income grows with it. And this is exactly where compounding becomes the heart of the entire strategy. Compounding is what makes a long-term approach work. Suppose you receive $50 in dividends this year. If you reinvest that $50, you now own more shares, which means next year's payout might rise to $55 or $60 without you adding anything extra. And if you add small monthly contributions like $50 or $100, the effect multiplies even faster. These small additions increase your share count, boost future payouts, and help your portfolio grow far more efficiently than relying on a single large investment. This is why long-term strategy and compounding always go together. In a couple of minutes, I'll walk you through the 5-stock portfolio that powers this strategy. And at the end, I'll show you how a simple $2 a day habit can grow into a portfolio worth over $400,000 that pays more than $1,000 a month in dividend income. Before choosing any dividend stock for the portfolio, it's important to understand a few key metrics that help you judge whether a company can sustain and grow its payouts. The first one is the dividend payout ratio. This tells you what percentage of a company's earnings is paid out as dividends. A payout ratio under 60% or 70% usually signals that the company has room to maintain and raise dividends, while a ratio consistently above 80% can be a warning sign of pressure. Next is the dividend coverage ratio, which shows how many times a company's earnings can cover its dividend payments. A coverage ratio of 2 or higher is generally considered strong because the company earns twice what it pays out. Ratios below 1 suggest the company is paying more in dividends than it earns, which isn't sustainable. Cash flow is just as important. Free cash flow, the money left after operating costs and investments, shows whether the company has actual cash to support its dividends. When that cash flow is steady, the company can keep paying you even when the economy hits a rough patch. Debt also matters. A healthy debt-to-EBITDA ratio is usually under 3, while anything above 4 can indicate higher risk. Too much debt can limit a company's ability to raise dividends or even maintain them. Finally, look at the dividend yield itself. A long-term, sustainable range often falls between 2 and 5%. Extremely high yields, like 8 or 10%, may look attractive, but often signal underlying problems. Understanding these metrics helps you avoid dividend traps and choose companies with stable, reliable long-term income. With those metrics in mind, here's how this portfolio comes together. When you're building a dividend portfolio designed to grow steadily over time, each stock needs to play a specific role. This 5-stock combination does exactly that by balancing stability, dividend growth, and long-term appreciation. Let's start with the foundation. The Vanguard S&P 500 ETF, or VOO, brings broad market stability with exposure to 500 major U.S. companies. Its current dividend yield of 1.13% isn't high, but its real strength comes from consistency. Over the past decade, VOO has grown its dividend at an average rate of 6.17% and delivered annual share price appreciation of 12.56%. This combination of stability and long-term growth makes it the anchor of this portfolio. From there, SCHD adds a stronger income base without sacrificing quality. It focuses on companies with reliable cash flow and solid fundamentals, which makes its dividend both stable and meaningful. Its yield sits at 3.78%, and its 10-year dividend growth rate has been 10.43%, with annual appreciation of 7.68%. This is the piece that brings dependable income and smooth, steady growth. Now we shift to the income-driven layer. AGM stands out with a 3.47% dividend yield, but what truly sets it apart is its exceptional 10-year dividend growth rate of 25.27%, paired with annual share price appreciation of 19.14%. AGM compounds quickly, giving your portfolio serious long-term momentum. RF, or Regions Financial, adds reliable banking sector income. With a 4.17% dividend yield, a strong dividend growth rate of 16.52%, and annual appreciation of 9.64%, RF provides predictable payouts supported by consistent performance. And then there's PLD, a real estate company built around warehouses and logistics properties. Its yield sits at 3.15%, with a 10-year dividend growth rate of 10.65% and long-term appreciation of 11.38%. It adds a different type of income stream backed by real assets and long-term demand. The next step is to calculate the portfolio's metrics, starting with the dividend yield so you can see what this 5-stock mix pays you on average. To keep things simple, we're going to use a basic method called a simple average. That just means we take the dividend yield from each stock, add them together, and then divide by the number of stocks in the portfolio. In this case, we have 5 positions: VOO with a yield of 1.13%, SCHD at 3.78%, AGM at 3.47%, RF at 4.17%, and PLD at 3.15%. First, we add all those yields together, so 1.13 plus 3.78 plus 3.47 plus 4.17 plus 3.15 gives us a total of 15.7. Then we divide that total by 5 because there are 5 stocks in this portfolio. When you do that, 15.7 divided by 5 equals 3.14. That's how we get the portfolio dividend yield of 3.14% using a simple average. You can follow this exact same process to estimate the portfolio's average dividend growth rate and its average share price appreciation as well. When you do that for this mix of stocks, you end up with a portfolio dividend growth rate of 13.81% and an average annual share price appreciation of 12.08%. So, to see how this plays out, here's what happens when John contributes $2 a day with no initial investment. After the first year, he would have put in about $730. And while that number looks small, it sets the foundation for everything that comes next. After 10 years, those tiny daily contributions grow into $15,236. After 20 years, the portfolio reaches $83,581. And by the 30-year mark, it's projected to be valued at $413,423. By that point, the portfolio will be paying roughly $18,166 a year in dividends, which comes out to about $1,514 every month. So, we have surpassed the $1,000 monthly target. When you break down the total returns, $391,523 of growth is added over the 30-year period. About $281,289 comes from share price appreciation, and $110,234 comes from reinvested dividends. Want to know the fastest way and the investment amount you need to reach $3,300 a month in dividends? Click the video on the screen to find out.